A central premise of my campaign for president was to change the tax code that was too skewed towards the wealthy at the expense of working middle-class Americans. Tonight, we've done that.
European shares rose strongly today after a long-awaited deal was secured in the United States to avoid a fiscal crisis in the world's largest economy. But what would the deal really mean for the US economy in 2013? Well, joining me now to answer that question is the FT's leader writer, Martin Sandbu. Martin, fears about going over the fiscal cliff have been averted, but are investors right to be cheerful, do you think?
Well, in one sense they are. Remember where we were just 2 days ago, New Year's Eve. It looked like we might go over not just one but two fiscal cliffs, the expiry of the Bush tax cuts and some other tax reliefs, and the self-imposed so-called sequester that the politicians agreed in 2011. In order to raise the debt ceiling, the Republicans demanded this package, a sort of straitjacket, automatic spending cuts in defense and welfare spending. Now that's been averted for now. Some of the tax cuts have been made permanent. The other fiscal cliff, the sequester, has been postponed for 2 months. So if you hadn't had that, you would have had a 4% of GDP cut in the deficit. That would have sent the US into recession. At least that's not happening right now. That's cause for cheer. I think that's what's driving this rally. But of course, this is going to be very short-lived.
So short-term cheer in the markets, recession averted. But what does this really mean, do you think, for the US economy in the year 2013?
Well, look, even this deal actually does lead to some fiscal retrenchment. As we know, income taxes go up on those above $400,000 income. The more important thing, less talked about, is that the payroll tax holiday was left to expire. So that means a 2 percentage point increase in payroll taxes on pretty much everyone on less than, I think it's $112,000. The real middle class is actually facing a tax rise, even though the politicians say they averted it. That's $95 billion a year, 0.7% of GDP. That will have an effect. So I think you'll continue to see subpar growth in the US, at least for this quarter. And then, of course, the other fiscal cliff, the sequester, was only averted or postponed for 2 months, and you'll have new negotiations when the new debt ceiling is hit around March. And that's going to be a renewal of all this uncertainty. So I think the rally will be short-lived. We'll see a lot of oscillation in the markets.
And finally, yes, let's just talk about those future negotiations. Politically, do you think, are we going to see more dramas like this unfold this year? And is there a sense really that the can is being kicked down the road, do you think?
There's certainly a sense of the can being kicked down the road. And politically, nothing has really been solved. On all sides, it's a bit unclear. Everyone had to give a little bit, but it also means it's less certain what they'll be able to stand up for later. We know that the stakes are higher because we'll hit the debt ceiling again, and that is the strongest bargaining chip that the Republicans in Congress have. As you know, the House Republicans mostly voted against this mini deal, even though Senate Republicans voted for it. So I think we'll find that we've postponed some standoff or deadlock, but only at the cost of getting an even higher stakes problem 2 months down the line.
Okay, well, Martin Sandbu, thank you very much indeed.
Thank you very much.